Good afternoon. This is Dan Bird with the daily scan for Monday. It is December, just starting, first trading day of December. And we're heading into the end of the year. This is brought to you by breakpointtrading.net. For those that are interested, I'm going to show you some things that I use my website for. If you're interested in signing up for an annual membership, it's for new subscribers only, but there is a special going on until tomorrow. $24 off Black Friday sale. So on the homepage, and I'll show you what this looks like, just click on the same Black Friday special and type in rally where it says coupon code. And I'll show you that in a minute. Disclaimer real quick. I am not a financial advisor. Nothing I say here should be construed as advice or recommendations to buy stocks or how to buy them. This is for educational purposes only. And I have no idea where the market's going. Nobody does. And each person has to determine your own risk profile, trading style, and take responsibility for your trades. And if you do decide to engage with a financial advisor, or even if you already have one, you might want to check them out on Investor.gov and just make sure that they are reputable. Okay, so let's go to the homepage real quick. And this is where you can sign up for the Black Friday special. It says promo code down here, but when you click on that, it actually is coupon code. So don't be confused by the wording. So this will open up, and for me, it's going to have things already filled in, but for you, it won't. So $99 is the normal price. Just type right here where it says enter coupon code, just type in rally right there, and you'll get the $75 price instead. All right, so let's first take a look at the market. Actually, I'd like to add one more thing. One thing that I do every month for subscribers is I do a Zoom call that's live and interactive. And I start off by talking about some of the new things that have been added to the website. And then I just open it up to anybody any questions anyone has. We can talk about the market, the overall world view of what the market might do, anything really that you want to talk about. And then lots of times folks want to know about specific stocks. So we can always look at those. And you can see that here's what the running time, 2.5 hours. And then I put the recording out here on the website. I also have some training out here for technical analysis for those that are interested. Two of these are training sessions that Tom Bowley did from Earnings Beats. And those were free, so they are available. I haven't tried them lately, so I'm not sure if they still work, but they probably do. But of course, he'll talk about his service as well. And I am a subscriber to Tom Bowley's service. He does an excellent job and provides some really unique information. And then all the previous newsletters are down here as well. So let's take a look at the market today. We'll first go to the dashboard. And you can see the Dow was down slightly, S&P was up slightly, NASDAQ up a little bit more, and NASDAQ looked like it outperformed the other ones. Small caps barely positive, mid caps a little bit negative. S&P is up. NASDAQ actually was the best performer. NASDAQ 100 was the best performer. Those are usually the large cap tech stocks, and the VIX is down to 13. That is amazing. The VIX is telling us that the VIX is calculated based on options 30 days out. So it's a volatility index, and volatility is very low right now. So it's suggesting that there's not much concern in the market, at least for the next 30 days. And we'll talk about that today. Bonds came down a little bit. Actually, the 20-year actually is still doing pretty well. So 20-year went up today. Dollar went up a little bit today. If anybody tuned into my session on the One Rental at a Time YouTube channel yesterday on Sunday, we talked about the Russian ruble basically crashing, collapsing, which is causing all kinds of issues for Russia right now. So that'll be interesting to watch. Commodities are mostly down. Gas is down. Gold is down. Everything here in the commodities looks down. Crypto, I'll show you the chart. But Bitcoin now is back to 95. Just can't get above that 100, but it's trying. We'll see if it can make it by the end of December. But that's what the overall dashboard looks like. I'll also look at the market carpets. I put this in my newsletter every week, but this is what it looks like. This is just for today. So you can see Apple, Microsoft, the ones that are in green did well today. Google, we actually added Google back to our daily scan worksheet. I'll show you that in a minute. Amazon's doing well, Meta. So all the big Magnificent Seven stocks. Broadcom, Oracle is the one that's lagging down here, down 1.86%. We had that on our list, but it stopped out, so we're not in it right now. Lilly's trying to make a comeback. So Lilly may have bottomed, starting to come back up. This is just for the day, by the way. Here's Walmart, and these are the top stocks for the day. This is something that Stock Charts offers. I sent out an email to everyone that Stock Charts today, and anyone that is interested in signing up for Stock Charts, you can just go to their site, and you should be able to find the special, but it's for today only. It's for Cyber Monday. I sent a notice out this morning to all of everyone that's either paid subscribers or not paid subscribers, everybody basically, just alerting them that that was out there. If we look at 5 days, so how it's done for the week, you can see NVIDIA actually is down for the week. And then we can go out 3 months, and you can see most of the Magnificent Seven big cap technology stocks have done really well. NVIDIA up 28% over the last 3 months. So that looks pretty good. Back to the dashboard. And down here, technology is the #1 sector today. So that consumer discretionary and communication services. These three are the three aggressive sectors. That's what you want to see when the market is poised to go up. The aggressive sectors leading, and all three of them are leading today. And at the bottom are the defensive sectors. Real estate and utilities are the two most defensive sectors, and they're at the bottom. So that is exactly what you want to see in a bullish market. You can see renewable energy is the #1 industry group for the day. This is the top 10. And look at number of discretionary XLY, 1, 2, 3, 4, 5. 5 out of 10. Here's semiconductors finally starting to perk back up again. Actually, if we look at the chart for semis, you can see right there, they were pulling back quite a bit for most of November. And they ended right there with a hammer. Let me highlight this, because this is interesting. So that is a hammer candle. At some point on tomorrow, I'm doing Technical Tuesday, and I've had quite a few people send in requests for what they would like me to talk about. I'm only going to do one, though, so I'll have to save the others for later. But at one point, I'm going to talk about candles too. But this is a hammer. When it's at the end of a downtrend, then it basically is telling you investor psychology. Zoom in on that a little bit. It's a visual representation of market psychology. So this was 3 days ago. So Monday, Friday, Wednesday, because Thursday was Thanksgiving, and Friday was a half a day. But on Wednesday before Thanksgiving, it had been selling off most of the month of November. It gapped down on Wednesday morning. It sold all the way down here to 18.5, and then by the end of the day came all the way back up again. That is a very bullish candle, especially at the end of a downtrend. It means that the sellers may be exhausted because it came back by the end of the day, came all the way back up, and then you can see confirmation the last 2 days. So semiconductors look like they're ready to move higher into the end of the year. And that's exactly what you want for the market. You want those aggressive sectors to be doing well. So XLK is technology. There's 1, 2 of those. Renewable energy, as I mentioned. And then XLC is the communication services, which is where the internet stocks are, like Google. So internet stocks made it to 2, 4, 6, number 6 out of 10 today. And over here are our top 10 stocks. So these are the ones that did well today. And if anybody's interested in these, I talked about how these get into the top 10. Marvell, interestingly, that is a semiconductor stock. So it's actually looking pretty good, breaking out right there. So that looks good. Just out of curiosity, I want to see what NVIDIA looks like. NVIDIA, I think, started coming up a little bit. Hasn't got above its 21 yet, but NVIDIA looks like it might be ready to make a run here soon too. So let's keep an eye on the semiconductors. All right, so that's it for that section. I would like to discuss something that somebody sent me. And they sent me a video from CNBC. A guy was talking about what he thinks about next year. And his comment was in 2025, he believes, and he gave reasons for it, and the reasons were reasonable. He believes that the market is going to end 2025 at 4,100. So let's take a look at that. I've got two charts here that I want to use to look at his thesis. And he said there's a few reasons for it. Number one, he thinks there's going to be a recession next year. And I have been saying that as well. I thought we might get one sometime in April or May, early Q2 next year. Of course, anytime there's a recession, then stocks usually go down. But will it go down to 4,100? So this right here is 4,100. And the reason he said that is because valuations are overstretched right now. And I'll show you where you can find that valuation chart in a second. But he's suggesting that the market is going to go down to 4,100. Now, he said by the end of the year, so we don't know where this could still keep going up into December. And I think it might have a good chance of doing that, actually. But if it were from right now, it would be a 32% decline down to 4,100. Now, interestingly, 4,100 is the bottom of this little pullback right here, or a pullback to the 50-day moving average. This is a weekly chart. So that's the 50-week moving average, or the 200-day. That's where that red one is. So you have to keep in mind what your time frames are. The 200-day moving average is down here. All right. So if it went to 4,100, it would come right down to the bottom of this right here. Now, that is pretty much in the middle of the 2022 cyclical bear market. So what he's saying is it's going to give back basically a year's worth of gains next year. And this could even be a little bit higher. So call it a year and 3 months. This is October, is where the low was. So that's what he's saying. Going to give back a year's worth of gains. So let's go look at the 2022 cyclical bear market. And by the way, if that happens, and if there is a recession, then the market will pull back for sure, which I've been saying too. And I've been saying that potentially it might look like 2022. 2022 looks like this. 2022 was down about 28%. So his thesis is worse than 2022. But let's take a look at what the decline was. So this decline in 2022 brought it back here almost to the high before the pandemic. That's where it pulled back to. Pull back right down here to the 200-week moving average right there. Keep that in mind because that's an important location. You can notice back here on a weekly chart, it actually went below that during the pandemic for 1, 2, 3, 4, basically 4 weeks, so 1 month. So keep that in mind as well. So down to the 200-day. So could this happen again? Could that pull back? Basically, in this case, it erased a year and 3 months. So absolutely, that's absolutely what could happen. So in this case, it pulled down right there and it erased 1 year and 3 months worth of gains to get to that point. So that's his thesis. I think potentially that could happen, but I don't think it's going to be that severe, but I think it could very likely pull back to this resistance point right here, which is at 4,500, 4,600. So 4,100, 4,600, it's about 500 point difference. 4,600, I think, is about the same as this. It's about 28%. So a cyclical bear market like we had in 22, that's about right, 28%. Now let's take a look at something else, because the key thing that we want to be watching is, will these cyclical bear markets turn into secular bear markets, meaning long term? And for that, I'm going to use my trusty secular bull and bear chart, which is on the homepage of the website. So, and it's open to anybody, so anybody can go look at that. I'll show you where it is in a second. But here are the indicators that tell us whether we're going back into a secular bull market. Secular bulls typically last 12 years. So this one here lasted from 2001 until 2013, 12-year run, so that it encompassed the dot-com bust and the financial crisis. And it did not finally get above these two highs until 2013. Secular bull markets typically last 18 to 20 years. So theoretically, this should last until 2029, 2033. Now, the interesting thing about this is you can see right here, let me see if I can get that a little bit bigger. You can see over here that the 2022 cyclical bear market came right down here to the 200-week moving average. Now, this is a monthly chart. So this is a 50-month moving average, the red line, but that equates to 200 weeks. So that's what that cyclical bear came down to, the 200-week. Now, if he is right, you can see this little piece right there, or pull back right there. You can actually barely see it, but you can see it. Pull back right there. That's where he thinks it's going to, 4,100, right at the bottom of there. I'll go back to this chart here. So right here, this is this little pullback right there. That's the 4,100 level right there. So that's what he said he thinks it's coming to. That's right here. Now that is below the 200-week moving average. Right now, already, it's below the 200-week. If all of this comes to pass and this cyclical bear market gets started in the first part of next year, then this 200-week moving average is going to continue to move up a little bit. It might come right to the point that I think it will come to, which is 4,600, and that's that horizontal line right there. So that's where I think. But none of these put it below the secular bull trend. Even if we pulled back 32% actually would put it below if it stayed there long enough. This is a monthly chart. Even in COVID, it did not stay down there. It went down, but it did not close during that month. The 2022 never went below the 200-week. His thesis would put it below it. And if that happens, then we have to be on high alert that the secular bull might be over and the secular bear might be starting. But if I'm right, then it's going to still maintain a secular bull, and it will just be another cyclical bear. And then it will reverse probably in October, which is where 7 out of 14 bear markets have ended historically. So that's where it probably will start back up again. We'll see if that happens. But you can see the other indicators here. It would take a lot. They would have to go down a lot. The 2022 cyclical bear came down, didn't quite hit it, and then started back up again. This is COVID right here. This one here is 2011 right there. So this one here is the MACD. It would have to get below the zero line to confirm, like it did right here. That confirmed the secular bear market right there. Be below, closing below the 200-week moving average, going below that RSI, relative strength line, and going below zero. Those are the three things that started this secular bear market. And it has a long way to go for those to happen again. But that's not to say it won't. It could. So, but we'll know it, with plenty of time. We'll have plenty of advance warning that that's coming. Just keep watching these charts. So where do you find these? On the website, on the homepage. You go halfway down, and there is the secular chart. Open to anybody. You don't need a subscription. That's how important this is. You can see where we are, and you'll know with plenty of warning what's going on. You can see the market bias right now ticked a little bit higher today as well. Actually, let me refresh the screen. Yeah, it went a little bit higher today, right there. The market timing trend is still giving us a green light. And you can find that, by the way, on the portfolios page, right at the top. You can find the weekly and the daily. The daily is what we use to identify that medium-term trend, but the weekly is the long-term trend. So you can see the long-term trend gave a signal back last October where we hit the bottom, and it has not given a sell signal yet. So that's over a year now, and it looks like it's just going to continue higher. So that's another thing you can watch to see if that starts rolling over and starts to turn red like it did during 22. It was red back here. So keep that in mind. Okay, another question that came in, and anybody can ask me a question. You can do it on either send me a note or you can do it on the YouTube channel, and I will try to address those as on each daily scan every day. So let's take a look at the next question was, can I tell people what my plan would be for TNA? Now, I talked about TNA, and I talked about how I got in it right here and got out right there on that shooting star candle, which is usually a reversal candle. And right now I'm not in it. And so this person said, you know, what would be your strategy to get back in? Well, first of all, it's just going sideways right now. And let me show you historically. This is what the market looks like for December. So December, the first week, which is where we are right now, that's where we are. First week, it may go up. It's going to be choppy probably. Next week is the CPI report, inflation report. I think it's going to come in flat. Market may or may not like that, but I think it will come in flat. And then we got the Fed meeting on the 18th, and I think that they will cut another 25 basis points. If that happens, you can see the dark red line up here. That is small caps. In this case, it's the it's the Russell small caps right here. So you can see they do really well in the second half of December. They do pretty well in the beginning, but it can be choppy. It can go up and then down again. Also, this is another one. This is also from Stock Traders Almanac. You can see this down here is the Russell 2000, Russell 1000 seasonal patterns since 1979, which is when it was first created. And look right here where it really starts to take off into the end of the year and really all the way through till March, right here in the middle of December. That's where historically, all the way back to 1979, historically, that's what small caps have done. So small caps love this time of year, December and January. So we'll see if that happens again. So what would be my strategy for this? So I'll tell you what I am doing right now. And I mentioned I got in down here and I got out on that shooting star candle, which is a reversal candle. But right now I have a stop buy order in at 57. 57 is right there. So I have a stop buy order in right there. So what is a stop buy order? Well, if you go back to the website, to the homepage, and again, this is open for everybody. You don't need a subscription for this. You can see what the orders, how the definitions of all the orders. So a sell stop is pretty easy to understand. If the price is at 10, you put a sell stop in at 950. So that's below the price. That means if it goes down to that level, it automatically turns into a market order and then it sells. If it goes down, fairly orderly, then it will sell pretty close to that price. If it gaps below that, it will execute further down. So a gap will not help you. But in general, a sell stop is below the price. A buy stop, on the other hand, is above the price. So a buy stop says if it's at 10, if this stock moves up to 10.50, then turn it into a market order and buy at whatever the price is. So in this case, the market order is 10.50, but in my case, for TNA, my buy order is in at 57. So what that means is if TNA keeps moving on, and by the way, TNA is a 3x small caps. So if the Russell 2000, which is IWM, is the ITF for it, and it will look exactly the same, almost exactly the same. There's IWM right there. That's Russell 2000, and here's TNA. Looks almost identical. The difference is TNA will move 3 times the IWM. So if IWM goes up 10%, this will go up 30%. So that's how I'm playing it. Now, could it go up and touch 57 and execute my order and then drop the next day and go all the way back down? Absolutely, it can do that. That is certainly what it can do. I cannot predict what it's going to do. All I know is that if it starts to take off like the historical trends indicate that it will, once it gets above 57, I will be in and it will continue higher. And then we'll do the same thing we've always done and put stops on this at certain points wherever it seems to make sense. And in this case, let's see. I thought I had one with a line on it, but I'll put another one. That's fine. So 57 is my buy order right there. And my stop order will be at, let's see where it will be, probably right here at the gap. Right at that gap, right there. So that's at 53.77, probably 53.50. Right there was where I'll put my stop order. Because if it goes down, then you will lose 3 times as well. It's very risky. But if you identify the trend and what's happening right now with this, and maybe this will be something I cover in a Technical Tuesday at some point, but it's consolidating in a sideways pattern right here. So according to consolidation theory, the move from here, which is roughly 46, let's call it, to the middle of this consolidation, which is about 56, that's a $10 measured move if it breaks out. And normally these consolidations break in the direction that they came into it. So it had been going up. So it likely will break higher, but that doesn't mean it has to. But typically the measured move will be 10 more points. So 56 to 66 is where it should move to. So that's the way I'm playing it. You can see that 57 area was also the high on this day was actually 56.77. So it's a little above this high. So my buy order is in right now. I'll let everybody know if it executes. I mean, you'll be able to see if it gets to 57, then it executed. But we'll keep an eye on that. This is one that I probably will not add to the worksheet, however, just because it is risky and it's a leveraged trade. So, by the way, if we take a look at the worksheet, right now I just added Google. So found that today on the downtrend reversal scan. Let me actually show you what that scan looks like. And let's see, this one right here. So I'll actually show you my email. So I have this set up to automatically send me an email whenever the scan triggers. So here's today, December 2nd. These are the ones that triggered for today's scan. Let's do it this way. So these are the ones that triggered today. You can see Carnival triggered. Coherent, which was on our list. So we can always go back to that. So it triggered today. Google is the one we added. Tesla also triggered. So Tesla started its move up again, up another $9 today. But here's Google. It's not really what I wanted. I already know what Google does. Here's Google. Okay, so there's the candle right at the 21-day moving average. And if we look at it on the holdings, daily scan holdings, look at Google. So there's where it hit the scan right at the 21-day moving average. Previously, it hit our scan, trying to remember, I think it was back here somewhere originally. Actually, it's still on the list, right down here. So here's Google. So yeah, it was right here. It's where it hit the list, and then we had stopped out. So pull way back here, and now it's moving up again. So we are in it now lower than we were in before, which is always a nice thing. So rather than having to worry about whether this downtrend was going to continue, we just got out up here. You see the original stop was down here. And as the price moved up, we moved the stop up. So if we hadn't moved the stop up and left it at our original stop, it would have still stopped out. It just would have stopped out at a much lower price. So in this particular case, with Google, we ended up with a 2% loss instead of like a 7% loss. Right now, our stop is at 167. So that would be a 2.8% loss. And by the way, I want to mention something about the calculations because there was somebody on the YouTube channel and a subscriber to my newsletter that said, I can't figure out where you get the 14%, because this down here did say 14%. And I understand the confusion because it's actually very difficult to try to quantify this. So each of these individual trades, it shows the gain loss for each of the individual trades. So that is the gain just for that trade. It's just the difference between the sell price and the buy price. Okay, that's what the percentage means. It is not a percentage of the overall portfolio. So like we said, the imaginary portfolio up here is 100,000, but you can't use 100,000 to try to figure out the percentage because we typically are never fully invested. I mean, the goal would be to get fully invested up here, but we never are actually using all of this 100. You can see right now the funds remaining is 67,000 that we can use to fill in the rest of these slots right here. So it was a very good point, and I wrestled with this a little bit and tried to figure out how to quantify this. What I decided to do is to take an average of the gain and loss over here after these trades are closed. So you can see the average right here is 1.7%. And then at the top, I annualize that 1.7. So I essentially take the 1.7 right here. I divide it by the number of days from inception, from the time that we started this exercise. And that is an automatically calculated field. And then divide it by 12 and then multiply. Actually, divide by 34 and then multiply by 12 to get divide by 34, multiply by 365 to get the annualized return. So that's how that works. And then the win-loss ratio is just simply the number of trades that are wins versus losses. And the goal is 40%. So it's not perfect. It's not going to be exact. Don't try to calculate these things because they're not going to come out exactly right. Other than in your own portfolio, they'll be calculated there. But on the spreadsheet, that's the way this one works. All right. So let me know if you have any questions on any of this about TNA or how I put this worksheet together, or Technical Tuesday is tomorrow. So tomorrow I'm going to talk about one of the requests was, and I thought this was an interesting one. Can I talk about the TTM squeeze, which is TTM squeeze is it's actually a free indicator that was put together by John Carter. And tomorrow I will explain exactly how John Carter came up with it and what it would look like if he had not created his own indicator. and then how it works. So stay tuned for that tomorrow for the Technical Tuesday. All right, this one went kind of long tonight. Sorry. Let me know if you have any questions or you would like me to cover anything else, and I'd be happy to do that. Thanks for joining, and don't forget the Cyber Monday special. So if you want to sign up, tomorrow's the last day. $75 instead of $99. $99 is still a great price, by the way. Incidentally, the worksheet that I was just showing you is on the portfolios page. That's where you can find the paper trade worksheet. It's right in the upper left corner right here. However, it's only available for annual subscribers. And the reason for that is there's a lot of work that I put into the risk calculator, which is right on this worksheet, that will help you identify, to manage your risk, how many, what your position sizing should be. And it took me 2 years to create this whole thing. So I'm not going to offer that to monthly subscribers because they have a free trial as a monthly subscriber, and then they could download that for free. So you do need to be an annual subscriber to get access to that. All right, thanks everyone, and I will talk to you again tomorrow. Good luck trading.